Today, we're comparing two cybersecurity leaders that have both surged over 400% in the past 5 years, but with two very different stories. Crowdstrike is the modern disruptor, born in the cloud and built for speed, while Palo Alto Networks is the battle-tested veteran. The question then is, should you invest in the younger, faster growing player or the slower growing seasoned player? Well, I built detailed 10-year valuation models for both stocks, and in this video I'll reveal my fair share price, final star rating and projected annual return to find the real winner. One of them is trading at nearly 30% below its fair value, while the other looks overvalued by more than 30%. So yeah, let's dive in with a quick intro to both companies. Cybersecurity is no longer optional. It's a must-have for every company, every country and every device, and two companies are leading the charge. We have Crowdstrike, built on speed, AI and scalability. Crowdstrike revolutionized endpoint protection with its cloud-native platform, offering real-time threat detection and AI-powered defense. They're about speed and efficiency for the modern threat landscape. And here we can see a snapshot of Crowdstrike's performance over the past year. We can see that revenue has been up and EBITDA as well, just barely, and we see an EBITDA margin of 7%. And at the same time, the stock price has risen by close to 28%, and the company is headquartered in Austin, Texas in the United States. And then we have Palo Alto Networks, a legacy firewall company. Palo Alto Networks, on the other hand, is an industry veteran with a broad, integrated platform covering everything from network to cloud security. They aim to be the one-stop shop for cybersecurity. And together, these two represent the modern versus the legacy cybersecurity battle. And both are striving for dominance in a market expected to surpass $500 billion by 2030. And here we can also see a snapshot for Palo Alto over the past year and see how they have performed. So revenue has been up and EBITDA has been up by close to 47%, which is absolutely massive. Now they have a high EBITDA margin of 16% and the share price has risen by 26% over the past year, and the company is headquartered in California in the United States. So the bull case for Crowdstrike is quite clear in my opinion. We have a company that's born in the cloud. Crowdstrike's Falcon platform was designed from the ground up for modern IT environments. And then we have explosive growth. It's been growing revenue at over 30% per year while improving margins. And finally, we have high retention and upselling. With a net retention rate of 120%, Crowdstrike isn't just landing customers, it's expanding them fast. On the other hand, there is a bear case as well. We have valuation risk. The stock is priced for perfection, trading at a rich premium versus its peers. And finally, we have high macro exposure. As budgets tighten, even cybersecurity isn't immune, especially premium vendors like Crowdstrike. Now for Palo Alto Networks, there is also a strong bull case. First of all, we have a reinvented platform. Palo Alto has gone from hardware-centric firewalls to a fully cloud-delivered security suite. Then we also have solid profitability. Palo Alto's mature business generates solid operating margins, and finally, some say it has undervalued growth. Despite its growth reinvention, the market still sees Palo Alto as an old-school firewall company. But as we saw with Crowdstrike, we also have a bear case for Palo Alto. First of all, there is execution risk. Managing multiple platform transitions from hardware to software comes with risks, and we also have slower growth, right? While strong, Palo Alto's growth is still slower than Crowdstrike's. Now, as we later on will do a head-to-head valuation for both stocks, let's start off by looking at some historical financial data we have going back 5 years in time. And here I have the core financial performance for Crowdstrike. We can see revenue in blue and we can see the EBITDA in green. And yeah, we can see that revenue has grown consistently at 46% per year on average, which is absolutely massive. And we can see the company today has a positive EBITDA margin at roughly 7.5%. And here we can see the exact same chart for Palo Alto. We can see revenue and we can see EBITDA. And yeah, we can see revenue growth has indeed been slower, right, at 24%, but the important part is the EBITDA, right? And we can see the company today has an EBITDA margin of 16%, which is over double the EBITDA margin of Crowdstrike. Now, let's also take a look at the debt sustainability for both companies to see if debt is any risk for us as investors. Here we can see debt in purple and we can see the excess cash in green. And for Crowdstrike, yeah, it's no risk at all. We can see excess cash is growing by 25% per year, and debt has remained flat over the past 5 years. Now for Palo Alto, it's a bit different. We can see that debt, yes, it's declining. That's a good sign, right? But previously the company had quite a lot of debt on their balance sheet, but today it's basically a third of what it was in 2022. And the excess cash has remained quite strong in that time, right? despite them using a lot of cash to pay down the debt in the company. As we later on will look at the free cash flow in the valuation, let's also look at the performance for Crowdstrike in terms of free cash flow. Here again we can see revenue in blue and the free cash flow in green instead of the EBITDA. And yeah, revenue has grown, but free cash flow has stayed quite flat in the same time, showing us that the company hasn't really expanded its free cash flow in the past 5 years. And you could say kind of the same thing for Palo Alto. We see revenue is increasing, right? But free cash flow is staying flat at best. This is a problem that both of these companies seem to have gone through over the past 5 years. Now, the final chart I would like to show you has to do with the share performance. We can see both the share price for each year for Crowdstrike and the number of shares outstanding in the company in millions as these blue columns. And yeah, we can see it's grown by 3%. So the company is essentially diluting shareholders by 3% per year, which isn't great. And for Palo Alto, it's kind of exactly the same story. We see a share price that is rising here, right, in the dotted line, and we can see the shares outstanding also growing each year by 3%, also diluting shareholders over the past 5 years. Okay, so now we have looked at the financial performance of both companies in the past 5 years. Let's move on to the valuation and start off with Crowdstrike. And as always, let's start off with the assumptions I have all the way up to 2034. So in terms of revenue growth, I'm assuming 16% per year. We've seen in the past 5 years 46% per year. Now that was from an extremely low base, so growth will eventually slow down. In terms of EBITDA margin, I'm assuming 35%, and in the past 5 years, we've seen 1% on average, so that's a huge assumption. And in terms of the enterprise value to EBITDA multiple, I'm assuming 30 times. In the past 5 years, we've seen negative 351 times on average. So yeah, assuming that the company will become profitable on an EBITDA basis. Now, in terms of free cash flow growth, I'm assuming 37 per year, which is absolutely massive. I think it's doable, but definitely bullish, assuming that the company will become consistently free cash flow positive. And the free cash flow yield, I'm assuming, is at 3.5%. So that's how much free cash flow we get in relation to the share price of Crowdstrike. And finally, I'm using a discount rate of 9.8% in my discounted cash flow analysis. And here you can see the yearly growth rates I applied for revenue and free cash flow all the way up to 2035. As the company's fiscal 2025 numbers ended this January, then 2035, this is basically calendar 2034. And for fiscal 2026, which is calendar 2025, I'm assuming 22% revenue growth. So that's in line with the company's guidance. And then I'm basically decelerating the growth all the way down to 10%. I'm doing basically the same, but with slightly higher growth rates for the free cash flow all the way up to 2035, assuming that the company will become more profitable. And yeah, with all of those assumptions, we get a fair share price for Crowdstrike today of $365. And this actually suggests that the company is trading at a 36% premium versus its current share price, and that we as investors could get 4% as an annual return. Now, given these numbers and considering the quite generous free cash flow assumptions, the best I can do in terms of a recommendation for Crowdstrike is a hold at this current moment, and 3.5 out of 5 stars as my final rating. Now, let's also take a look at Palo Alto stock and see how it compares with Crowdstrike, at least from a valuation basis. Now, in terms of revenue growth, I'm assuming 12% per year. That is lower than Crowdstrike's assumption of 16% per year. And the EBITDA margin, I'm assuming at 38%, so slightly higher than the 35% I assumed for Crowdstrike. Now, in terms of enterprise value to EBITDA multiple, I'm assuming 25 times. That's also lower than Crowdstrike at 30 times, assuming that the company will become larger, grow slower, right, than Crowdstrike, hence it should have a slightly lower multiple. On top of that, I'm assuming free cash flow growth at 24%. That's slower than Crowdstrike, as the company today already has much stronger free cash flow than Crowdstrike. On top of that, I'm assuming a free cash flow yield of 4%, and I applied a discount rate for my discounted cash flow analysis of 8.9%. And yeah, here we can see the yearly growth rates I've applied for Palo Alto stock for revenue and free cash flow, and it follows kind of the same logic as I did with Crowdstrike. I assume 14% in this case revenue growth for 2025, as that's in line with the company's guidance, and then I basically decelerate revenue growth all the way up to 2034, and I apply the same logic for the free cash flow as well, just to stay conservative. Now, with that said, let's take a look at the impact this has on the valuation. Now, keep in mind, I'm assuming slower revenue growth and slower free cash flow growth than I do with Crowdstrike. So yeah, let's see. If we apply all of those assumptions that I went through, we get a fair share price for Palo Alto today at $284. And this implies that the current share price is trading at a discount of 28% versus its fair share price, and that we as investors could get 9% as an annual return. And this shows where a company that's growing slower, right, sometimes could be the better investment. It all has to do with valuation, and it all has to do with the expectations investors have today of these companies. If you're enjoying this video so far, feel free to drop a like or subscribe or check out my channel. It really helps out. Now, a great stock, as you may already know, in my opinion, is not only a great business or that it's well priced. It has to do also with momentum. And let's take a look from a technical point of view if Palo Alto or Crowdstrike today has any momentum. And the short answer is a strong yes for both of these companies. In the case of Crowdstrike, as we can see here, we can see the stock chart over the past few years. The stock is performing really strong. It's outperforming the S&P 500, and on top of that, it's following its long-term trend line. And if we zoom in a bit, we can see that the stock price is above a long-term support line, which is this green line, and it's also above the 200-day moving average, which is this blue line you can see here below, which is the average share price over the past 200 days, which is another bullish signal. Now, if you are bullish of Crowdstrike, we can see what happens to the annual return, which is currently 4%. If the stock price goes down, that's good for new investors, or if the stock price goes up. And yeah, if you'd like returns that are in line with the market, so that's 8 to 10%, then the stock has to go down by 30 or 40%, which I don't know how realistic that is. And taking a look at Palo Alto as well, we can see the same story here. We can see a stock chart that is going up to the right, and that's amazing to see for current investors. The stock is following its long-term trend line, and it's above its 200-day moving average, as we can see here. On top of that, Palo Alto stock has been more consistent than Crowdstrike, and with that I mean the company has performed as well as Crowdstrike, but with lower volatility. However, we can see that the stock is close to a historic resistance line. We can see here the share price at roughly $207. So the question then is, will the share price break above or below and return back to its long-term trend line? Now, in terms of Palo Alto, we can see that yes, we have 9% currently as our expected annual return, and we can see yet again what happens if the stock goes down or if the stock goes up. And yeah, if you'd like returns that are closer to, I guess, 15 or 20%, then the stock has to go down by 30%, and then you get at least market-beating returns going forward in the coming 10 years. Okay, so here we are at the end. Let's take a look who is the winner in my opinion. So in terms of historical revenue growth, yes, I would say Crowdstrike is the winner in that category. As well, when it comes to future revenue growth, this is a company that's growing at a higher pace than Palo Alto. Now, in terms of profitability, I would say that Palo Alto is the winner. It has better profit margins and it has stronger free cash flow margins as well. Now, moving on to the valuation metrics. We saw my assumptions before and the expected annual returns that we got. And for that, I would say that Palo Alto is the clear winner. I prefer 9% than 4%, even though it's not really beating the market. And finally, we can see the discount and the premium versus its fair share price. And yet again, Palo Alto is the winner. Finally, I would say that actually Palo Alto is the final winner of this head-to-head. Yes, it's the company that's growing slower, and you could say it's the older company of the two, but valuation matters. Sometimes buying the company that's growing slower at a better valuation might be the better investment than buying the company that's growing faster at a much higher valuation. Thank you so much for watching this video. If you found it informative, feel free to like and subscribe. And if you'd like a free one-pager of either Crowdstrike or Palo Alto, please go down to the description below and you get 5 years of financial data, my full valuation assumptions, and a forecast summary as well. So yeah, thank you, and I'll see you next one.